Today, giving credit where credit is due. Hello again, it's Martin North from Digital Finance Analytics. Welcome to latest posts covering finance and property news with a distinctively Australian flavour. Well, the RBA and Apra have now released their credit aggregates for the month to the end of January. And of course, all the media was spruiking the rising credit and how the momentum is just going to the stars. But the truth is that things are not quite as straightforward as many are talking about. So today I want to go through the RBA and APRA data, but also just set some of it in context and respond to a couple of viewers' questions who are asking me about what's the forward outlook for house prices and also for defaults. And once again, of course, we're seeing lots of issues being hidden and a lot of people misconstruing the data and claiming that everything is wonderful. Well, it may be for some, but for others, not so much. So the RBA published their financial aggregates to January 2021, and they reported that total credit grew at 1.7% for the 12 months to January 21, compared with 2.5% a year ago. Housing grew 3.6% annualized over the year, compared with 3.1%. Personal credit was down 12.4% compared with 5% a year ago, and business credit rose just 0.5% compared with 2.7% a year ago. So none of this really is significantly positive, other than, of course, that housing rise. And it's worth saying, of course, that the aggregate numbers are the net of new loans being written and old loans being paid off, mortgage refinancing, and all of those things. However, it doesn't include things like afterpay, if you look at personal credit, and it doesn't necessarily include all of the activity from the non-bank sector, because some of it doesn't get caught by the statistics. So we have to be a little bit cautious once again, but nevertheless, it does give us a bit of a stake in the ground. So let's look firstly at the monthly credit aggregates. And we can see there that overall lending for housing in the month rose 0.39%, slightly above the long-term trend, but still lower than it was back in 2016-17. Owner-occupation lending rose 0.54%. In fact, it fell slightly compared with the previous month. Investment lending rose 0.12%, and again, it's just slightly higher, but way down from where it was back in 2015-16. Personal credit was down 0.92%, and business lending was down 0.1%. And once again, I have to underscore that business lending is still very anemic, and that is not a good sign for the future of the economy. And we can also look at the total credit, which was up 0.21% over the month, and the broad money was up 0.66%. And once again, it's worth underscoring that the difference between broad money and credit growth is concerning. So the Reserve Bank is pumping a lot of money into the system, and I guess also the government stimulus packages are also supporting the momentum, but it's not translating to credit growth. And I'm going to argue that this disconnect between credit growth and stimulation is one reason why I am not convinced that inflation is really on the horizon. The fact is, a lot of that money that's being created and thrown around the system is not hitting the real economy, and many businesses are still concerned about their futures and still very cautious about their investment plans. Now let's look at the annualized numbers, and we can see there that housing rose 3.64% over the last 12 months, slightly up from previously, but not dramatically so. Owner-occupation credit growth was up 5.68%, again slightly higher, and certainly compared with where we were at the end of last year, that is slightly stronger. Investment lending up very slightly, up 0.09%, but at least I guess it's in positive territory now, but still annualised over the year hardly anything to see, and certainly way down from where it was back in 2015. Personal credit down 12.37% annualized, and I think here we see a structural change. A lot of people are not using now the credit facility products from the banks, or indeed even credit cards. They're using other mechanisms like Afterpay, which aren't included in the numbers. Business credit growth annualized up 0.51% is as low as it's been for a long time. Now this is an animation of the RBA aggregates annualized, and you can see there the very strong growth in investment lending through 2015-2016. Then owner occupation came through very strongly. Business credit started to go a little weaker. Then investment came back a bit in 2017. Then we saw them slide away. And of course, more recently, we saw the rise of M3 and broad money as the stimulation package ran through, but lending remained somewhat lower. And if we then look at the net contribution, annualized credit growth at 1.72% still languishes right down at the bottom of the range. And broad money is still at 12.82%. And that divergence, as I said earlier on, really underscores the risks in the system. And I am very skeptical, therefore, of any real increase in inflation, because the money that's out there is not necessarily hitting the real economy. It might be chasing assets, it might be chasing stocks, but it's not hitting the real economy at this stage. And of course, it's also worth reflecting on this, that the Reserve Bank has banked the future of the country on the housing sector and housing momentum. The government also, of course, through its stimulus packages. But we should also be very conscious of the New Zealand situation, where, of course, house prices there are now forecast to rise above 22% over the next year before falling back. And now they're worried about overheating in the housing sector and indeed taking steps to try and tame it. So this is a very concerning situation for the economy, in my view. Now, let's turn to the Apra Statistics, so the monthly authorised deposit-taking institution statistics, again to the end of January, shows the pool of loans that the banks have made. And here we saw that both owner-occupied lending and investment lending was higher, but the proportion of lending for investment purposes was down again. And if we look at the changes over the last month, the owner occupation loans rose by 2.25%, which is as strong as it's been for a long time. Investment lending was up 0.5%, so that's pretty strong too. And total credit growth was up 1.62% over the month. So you can see the banks are actually working quite hard to try and push more credit into the system. It's just that the net impact of that is actually pretty low compared with the overall economy, as we showed earlier on from the Reserve Bank. Remember that, of course, we're not looking here at the non-bank sector, only at those within the banking system. Now, it's worth looking at selected portfolios because there were considerable changes amongst different banks. This is just a few selections. You can see there that Commonwealth has been focusing on owner-occupied lending. Macquarie, pretty strong on both owner-occupied and investment lending, as Westpac. Now, of course, Westpac has now moved back into positive territory after a number of months where it was going negative. ANZ, a bit the same. Bendigo and Adelaide Bank, also positive. Interestingly, National Australia Bank reduced their footprint on the investment side of the house, but grew their owner-occupied lending pools. And we then see that people like Bank of Queensland, HSBC, are also active, and ING on owner-occupied lending, but not necessarily on investment lending. And we saw also that Members Equity Bank, of course, now to be acquired by Bank of Queensland, was down a little. And we also see a couple of others there, including Suncorp, who are going backwards. So once again, we see an interesting divergence of strategy between different lenders, some quite active and driving pretty hard, some less so. Remember, of course, that they are receiving very, very low funding from the Reserve Bank at the moment through the term lending facility, and that means that they should be able to lend and lend at a reasonable margin, although the recent results that came through indicated that most of the lenders are actually still experiencing significant margin pressure, which begs the question, if you continue to lend And at very low margin, what's that going to do to future profitability, particularly when the Reserve Bank's term facility will come to an end later in the year? And also Fitch Ratings came out with their latest report saying that the 30-day plus arrears in the fourth quarter of 2020 for Australia rose by 2 basis points to 1.01% from the previous quarter, as borrowers struggling with the economic fallout from the coronavirus pandemic continue to take up payment deferrals offered by Australian lenders. Now, the agency does not expect their DINCOM index to increase significantly until the payment deferral period ends on the 31st of March 2021, as the regulator has advised that deferrals do not need to be treated as arrears. DINCOM transactions had 1.7% of borrowers under payment deferrals at the end of the fourth quarter 2020. That's 310 basis points lower than the previous quarter, and conditional prepayment rates for transactions issued by non-bank lenders have recently increased to 23.3%, significantly above those issued by banks, likely due to borrowers refinancing to take advantage of low fixed rates offered by some banks. Home prices, they say, rebounded from a decline of 2 consecutive quarters, increasing 1.8% quarter over quarter across Australia's 8 capital cities, but of course that was not uniformly spread. Fitch expects prices to continue rising, supported by record low mortgage rates, a lower supply of housing stock, and government incentives for housing, particularly for first home buyers. Losses in the residential mortgage-backed security sector transactions from the sale of collateral property were the lowest in the last decade, with lenders' mortgage insurance payments and excess spreads being sufficient to cover principal shortfalls in all transactions during the quarter, they said. But Fitch expects losses to stay low due to recovery in home prices. Well, we'll see, shall we? And meanwhile, Apra said that as at the 31st of January, according to data submitted by ADIs with over $20 million in loans, subject to repayment deferrals, a total of $37 billion worth of loans are on temporary repayment deferrals, which is around 1.4% of total loans outstanding. That's down from $50 billion, or 1.9% of total loans outstanding in December 2020. Housing loans made up the majority of total loans granted repayment deferrals and have a higher incidence of deferrals, with 1.8% of those loans subject to deferrals compared to 1.1% for SME loans. Exits from deferrals continue to outweigh new entries for the 7th straight month in January, with $14 billion worth of loans expiring or exiting deferrals and less than $1 billion entering or being extended. But worth noting, there are still some coming on rather than all going off. Victoria remains the state with the highest proportion of loans subject to deferral at 2%, compared with the rest of the country at 1%, though this difference, they say, is narrowing. And the other point to make, just quickly, is that Apra shows that ANZ has the largest share of SME and housing exposures, whereas NAB has the lowest. Now, the Apra data that came out yesterday caused Tim Lawless from CoreLogic to tweet the following: "The risk of a surge in distressed residential property listings has substantially diminished, with Apra reporting today the value of deferred home loans falling to $32 billion by the end of January, reporting 1.8% of mortgage books, down from $195 billion, or 11% in May last year." Now, I just want to make the point here that there is a disconnect between distressed residential property listings and the deferrals. The deferrals were put in place, of course, to protect people through the COVID cycle. But we haven't yet seen the emergence of distressed property borrowers. That's going to be some months down the track, as I'll explain. So in a way, I think Tim here is conflating two issues, and you could argue perhaps it's a bit spooky. Perhaps to get a better read on what's going on, let's look at Business Insider, who wrote this: Australian banks are bracing for difficult conversations with borrowers in 2021 as loan deferrals begin to expire. And that's the point. We ain't seen nothing yet. And Business Insider said, speaking at an Australian Banking Association event last Friday, it's a week ago, CEO Anna Bligh said that the number of impaired loans is expected to rise in coming months. We do need to acknowledge it's early days. The number of customers who have exited deferrals and those loans are now impaired is 1.4% of all those who deferred their loans to date. For a loan to be considered impaired, of course, or non-performing, a borrower must not make a payment for 90 days. There are obviously a number of customers who might get closer to that point now, and I would expect that 1.4% to grow, she said. While Bligh said she doubted the percentage of bad loans would soar tenfold, she considered that many Australians may find themselves in trouble in 2021. It's a small percentage, but it's still thousands of people, and it's going to be a real challenge, she added. Now, with Australians currently not making repayments on around $28.7 billion of debt, more than $25 billion of which is home loans, there's certainly potential for more Australians to default, the article went on to say. In response, the ABA unveiled new sector-wide measures to come in April to guide those customers through the process. However, with many of the options they face, including loan restructuring and moving to interest-only loans, being only offered for months, that may be just simply postponing the inevitable. And we're going to see, I think, a bit more. Remember that Apra currently has allowed everybody to pretend that loans are fine if they're actually restructured or if they're deferred, but that, of course, will also end in March. Now, in that Business Insider article, they wanted to say that throw in the fact that income support in the form of JobKeeper and JobSeeker is being slashed at the same time deferrals end, there are some real concerns over how some households may cope. The number of business insolvencies at the end of 2020 was about half of what it is broadly in the normal year. And the number of customers that are going through a sale in housing due to financial difficulties is around half of what it's been in prior years, Matt Common from the CBA said. It gives you a sense of how much support has been in place. As that recedes and some sectors like tourism, aviation and education are still unable to return to normal operations, Common expects there to be individual cases where customers will have to face some tough decisions. Some businesses have done extremely well, and some that through no fault of their own are in very difficult situations. He said, we absolutely recognise that there will be difficult conversations during the course of the next year. And incidentally, there was also some discussion about responsible lending and how that might help customers. Remember, they're winding back responsible lending later in the year. I think it's a major mistake. Nor are the big banks concerned that the revision of responsible lending could throw fuel on the fire in a hot housing market. The key is really not to increase borrowing capacity or indebtedness, nor to water down any of the consumer protections, but to recognise that perhaps some aspects of the loan process is not particularly helpful, Common said. Common, also the chair of the ABA, was backed up by the deputy chair and Bendigo Bank managing director, Marnie Baker, saying it would make customers' lives easier. It's really about streamlining the application process around the data that is actually collected, she said. The underwriting of the loan, the standards of the bank doesn't change. It doesn't make any sense for the bank to lend money to someone who cannot repay it. And noting lower income households spend bigger as a result of the income support, while higher income households cut back discretionary spending, Accenture economist Andrew Charlton forecast that 2021 would see a normalisation of spending. So in other words, this is a significant warning that we have not yet seen the worst of the situation with regard to deferrals and defaults. Deferrals may be coming off, but defaults are likely to rise. And if you do the math, let's assume that things end at the end of March and that then the 90-day default counter starts then, and then allow the banks a couple of months to handle that issue, I would expect to see defaults rising later in the year, probably around August, September, October. So it seems to me that if I was thinking of buying property at the moment, I just might hang off and see how that plays out, insofar that the booming prices in some areas, not universally of course, and not in units, mostly houses, is going to be temporary. And I have a feeling that people might be shocked, particularly, of course, if it's true that interest rates are also going to rise sooner than many expect currently. See my earlier post on the bond situation that I made yesterday. And just back on the insolvency question, there was another article in the Australian Business Network that makes the point that construction firms remain hardest hit for insolvencies, and New South Wales leads Australia for company collapses according to the latest figures from the corporate regulator. Data from ASIC showed 192 insolvencies across Australia in January, 72 of which were in New South Wales. The state leads Australia with 831 business insolvencies in the financial year to date. But like other states, the January total is more than 50% below pre-pandemic figures. In total, 27 construction companies across Australia went into insolvency in January, and that, of course, is right in the middle of the government's stimulus packages to try and help the construction sector. The bust in construction work comes amid a broader downturn in the high-rise commercial and residential market, marked by the explosion of industry titan Grocom, which tipped even more of its operations into insolvency on New Year's Eve. January also marked the first month for many businesses trading without the extended temporary debt protection imposed by the federal government in the early days of the pandemic. Food services were the least worst sector impacted, with around 27 operators in the food services and accommodation sector having joined the list of insolvencies during December. The next most important sector for business busts was financial and insurance services, with 18 ending operations in January. And according to ASIC data, the 192 business busts across Australia in January was a decrease of 51.6% from the same month in 2020, just as COVID-19 waves were threatening to crash down. The 72 businesses that went bust in New South Wales in January were down 48.9% from the 141 that went bust a year previously. And New South Wales was swiftly followed by Victoria, where 51 businesses went to the wall in January, but is still a long way down from the total recorded the year before, where 124 went bust. And Credit Watch CEO Patrick Conlon said the full January numbers came in as no surprise, but flagged to expect far higher figures as the economy exited government support in the coming months. We're expecting to see an increase in court actions, particularly default judgments, as creditors start to chase debt with a bit more vigour and not having to wait 6 months. He said, we'll also see an increase in administrations, at least back to a normal 2019 number. And Credit Watch, which tracks average payment times across businesses, said the numbers would come to a head leading out of April. We're not going to see the tsunami and cliff that was projected for September that ended up getting pushed back to March. He said, the end of JobKeeper will spur activity. There will be businesses out there that are still solely reliant on JobKeeper to keep them afloat, and that will be the death knell. And it's also worth noting that Liberty, one of the lenders in Australia, has warned about the need to cool housing. It's been very strong and stronger than expected. He said, it may normalise in the coming months. I certainly don't think it's a good time for our economy if we see house prices increasing by 10% plus every year for a couple of years. He said that kind of outcome wouldn't be good. But we'll have to wait and see as we move through autumn and winter if it stays where it is. It's also worth noting that outgoing Stockland Chief Executive Mark Stein on Thursday said the housing market shift into a chronic undersupply in growth corridors around major cities in coming years, with newly upgraded forecasts underscoring the importance of getting policy right as the market takes off. Yeah, well, of course, they're talking the book once again. Way too much supply of property. And, of course, just a reminder that Westpac this year lifted its own forecast for dwelling prices. They now expect 10% in 2021 and 2022. The bottom line is that Australia's housing upturn now has strong momentum, and it looks to be lifting further and will remain well supported by monetary conditions and an improving economic backdrop. Westpac economist Bill Evans and Matthew Hassan said. Well, if you want to get a bit of an update on what's going on the ground, you should join our show next Tuesday at 8 p.m. Sydney time, where I'll go through the latest household stress and property market analysis that we've done. The data has just come in. And once again, I think people might be a bit surprised by some of the data because there are definitely some interesting positive developments, but there are also some negative issues too. And as I have said several times and will say again, if you think this is all over, then you're missing the point. March is not the beginning of the end. It might be the end of the beginning, but I certainly think that we're going to see continued pressure on many sectors of property in coming months and indeed years. And once again, I should remind you that if in fact the Reserve Bank is forced to lift rates sooner simply because of the international capital markets and the broader context, then this could be a significant negative drag too. So, to answer the specific query that I got from my viewers, do I think prices are going to go higher or lower? They're probably going to go a little higher in some areas over the next few months, but the long-term trend probably is going to be less positive than many believe at the moment. And again, I remind you of what's happening in New Zealand, where prices bubbled up, and they now expect at 22% over the next year, and then will fall away again. And people who bought in that rising trend will be with big mortgages and will be highly exposed. So whatever you think about trajectory on property prices, I think you should be very cautious. Make sure that you've got plenty of buffers if you are going to get that mortgage. And don't assume that interest rates will stay as low as they are at the moment. Don't assume significant momentum in house price growth. And specifically, be very cautious of high-rise developments, both new ones off plan and also those that have been around for a few years. I discussed this earlier in the week on a special show that I did as part of a collaboration with The Australian. Worth watching, and also worth watching to see how some of the spruikers reacted to some of my more data-driven observations. So to conclude, continue to watch the data, continue to be cautious, don't be swept up by all of the spruiking, which is turned up to 11 and will continue. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.